Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, any kind of real estate investor, Gray Report is the place where you want to be. We're covering all the latest research reports, data, articles, throwing out some original opinions on the multifamily industry, real estate in general, and then just the economy at whole. And this week we have some incredible news. A lot has happened just in the last 24 and 48 hours. We've got Matt Bosnagel, Director of Communications and Marketing here at Gray Capital, can help us break it all down. He's staying just white on rice on top of all this stuff. It's really awesome. So we're going to be looking at GDP print. Came out yesterday. The FOMC committee, another 75 basis points raised to the Fed funds rate. And so that begs the question, are we in a recession? We've been talking about it here for months now, the Gray Report. But also, we've got a single-family home market that's cooling. Multifamily still looking pretty good. But then the question of, has all of the momentum in the market, is it shifted to the suburbs? Is that the new place to be? Well, we're going to be talking about all of that and more. So let's strap in and get into it. All right, everybody, welcome back to the Gray Report. Matt Bosnagel joining us again. Matt, how's it going? Exciting report this week.
Yeah, pretty good. A lot of things have been happening, not the least of which is the interest rate and the GDP numbers came in. A lot of changes, and it was very easy to write the newsletter this week. This is
So
a little bit of.
There was no question of what needs to be in the report.
Yeah, not exactly, and this is kind of the curse of interesting times a little bit, but not so much maybe for the multifamily market, which I can kind of explain.
Yeah, multifamily seems to be going relatively kind of steady as she goes, at least from the performance side. Demand seems to be incredibly strong. Still price discovery kind of in the acquisition space with interest rates being high and buyers just not sure if they're willing to pay up so much like they were last year. With interest rates higher, they're going to have to be using negative leverage because the cap rates are still low. A lot of groups waiting to see, can these cap rates rise a little bit? And we'll see how much they do. I think we've already seen kind of 25 to 50 basis points in some markets. But Matt, let's get into multifamily in just a little bit. Let's talk about some of these macro stories because a lot of stuff going on. First, just what came out this morning is a print of GDP. Now, again, these are early numbers. They're going to be revised, Matt, as you were just mentioning earlier. So take a little bit of a grain of salt. I think we had a decent idea that this was going to come in negative because of the posturing from the Biden administration of basically messaging all this week and a little bit last week of, hey, just because we have 2 consecutive quarters of negative GDP growth, that doesn't technically mean we're in a recession. Although maybe technically it does, but I guess it all depends on who you ask in the committee. And now we're talking about semantics. I feel as though anytime you're arguing about those semantics, you've kind of ceded.
No, there's a committee. Debate. There's a committee. That committee gets together. They think very hard, and then they tell us if the economy's doing poorly and if we're in a recession. It's kind of like if it's raining outside. I don't know if it's actually raining until I look and the meteorologist tells me. I could get wet, but what do I know? So you got to have that committee because otherwise, what would reality be? I don't know.
That's a good point. So we're going to wait from this committee to tell us. There's no politics in that committee, I assume. It's all just very empirical. Nothing, no politics involved, right?
That's right.
So, I mean, I guess let's just look at the facts. For the facts. I mean, why even call recessions? Because if if it's a moving definition, then we're just describing economic conditions that aren't ideal. We're having a contraction. And is there any argument out there that we're not seeing some kind of contraction and a resetting of asset prices across the globe?
I think especially the global aspect of it is very true. This is not just a national phenomenon for sure.
And what will be interesting, you're right. It's not a U.S. problem. In fact, Europe is in a much worse case than the United States. I mean, the United States is doing relatively well. I mean, the dollar is incredibly strong right now because we've risen rates, quite a bit. Where a lot of other economies and central banks have they've risen a little bit, but they still have relatively loose monetary policy. But yeah, I mean the World Bank just issued warnings this week for a potential global recession, and then a lot of other calls for a recession early in 2023, followed by actually declines in interest rates, where the Fed would lower rates after a recession. So some people calling that, saying there will be a recession. It's going to be in a couple months, but again, it begs the question: has that already begun, or is just the first inning? And it's yet to be seen, and it's going to be an interesting 12 to 18 months for sure.
It does. I will say, less on the less like hyperbolic front, it is kind of a little bit difficult to see where we are with like, we're in the middle of something, and it's hard to figure out. We don't have the perspective yet. And part of this is we don't have the information yet. There's all these economic figures that come out every month, but a lot of times they're revised. This quarterly number for GDP could be revised up or down, and we kind of don't know. But my thing is, I don't think that the boiling frog metaphor works right now. I think that a lot of people are worried, rightly worried, about the economy, and I think they'd jump right out of these overheated conditions if they could.
I think that's a good point. I think maybe the metaphor does hold true, but it just they're not warming up the water slowly. It's the water's boiling. They're throwing the frogs in, and the frogs are jumping.
Yeah.
I mean,
maybe it's just because we're mammals. I don't know.
Yeah, we're not cold blooded. That's a good point. Yeah. Hey Matt, you want to turn this Barron's piece? When will inflation peak? Experts weigh in, because I think that a lot of this discussion on whether it's GDP, growth, interest rates, is this question of inflation. And there's a lot of experts now saying we are at peak inflation.
Yeah.
There have been experts that have been saying that for the last 18 months also. So I think taking it with a healthy grain of salt, because while there are a lot of factors such as supply chains, COVID shutdowns that have, eased up, we're having all now the secondary and tertiary effects of that, the prices rising and some of these feedback loops of rents rising and housing rising, and then wages rising, and then prices rising more, and then housing rising even more because people are making more money. And as we've seen, the rent increases and the housing prices really going up, especially like mortgage rates, that's happened recently. Kind of after a lot of these supply chain issues were worked through. As housing prices rise, often that leads to further wage growth. And we're really starting to see wage growth accelerate. That is going to be inflationary. But what are some of these experts say? They're certainly smarter than I am, man. I don't know about you.
I always try to kind of get. I wonder what's the consensus. They don't poll every single economist every month, unfortunately, or probably fortunately, because that would go crazy. But this was a nice, almost like a 5-in-1, and they asked them, has inflation peaked? And guess what? Emily Rubin, Robert Phipps, Jennifer Cute, Eric Bealey, Samira Arakat, and Randy Bruns, all of them pretty much say that inflation probably has peaked. So I think that, maybe you can put your money back under the mattress and put all your cares away, because inflation has peaked and it's on the way down, according to all of these sources. But more seriously, I think that discussions that we have hit peak inflation, those discussions that were circulating a few weeks ago have really started to build momentum. And there's still a lot of uncertainty. It's funny when you were talking earlier, I kept thinking of the headlines that I was writing and reading, a year and a half and 2 years ago, about how multifamily is this island of stability amongst economic uncertainty. Now we had the beginning of the pandemic at that point, and now we have kind of inflation and interest rates now. But if you're talking about uncertainty period, well, multifamily does not have that. At least the fundamentals are very strong for apartments. But on the other side, we've got this inflation, and no one knows quite when it's peaked or not. But the hope is that it's going down.
Yeah, I mean, multifamily, certainly isn't immune and completely separated and not completely uncorrelated from markets. But man, if you go back through and look at the last 4 or 5 recessions, especially if we're in one now and then the pandemic. Multifamily did really, really well. And even back, if you go back to the great financial crisis, where there was an actual housing crisis and a complete collapse of the financial system, uh, you know, apartments, they declined in value. But if you were owning a stabilized cash flowing apartment, you didn't lose your shirt. You just had to hold on for a couple of years and you were just fine. And if you had the ability to hold on, you actually make quite a bit of money, even if you purchased kind of at the peak, 2006, 2007. So
now, I think,
go ahead.
There is a connection between the economy. I was trying to say that we're the island, but I guess no apartment is an island. And a more compelling argument about inflation actually comes from one of these economists, Emily Rubin, and from UBS. And she says that categories like labor and housing are going to be stickier when it comes to inflation. And then another economist polled says that the delayed way in which housing data are reflected in the inflation numbers is likely to make inflation look even worse than it actually is over the next 3 to 6 months. That was Robert Phipps that said that. And I tend to agree, and we've talked about this before, how it's a little bit of there is more momentum, at least, when it comes to apartment prices. And I don't think that we've seen the end of it at all. Maybe this is just the beginning of apartments, and I've mentioned this before, of apartments driving inflation.
I think so too, and we've mentioned this, Matt, just anecdotally. There's much more conversations around apartments and rents in the mainstream financial press than there typically is. Usually, it's a sector that's just kind of ignored. It's not that sexy. It's not that exciting compared to Tesla and crypto and Apple's earnings. But whether it's on Bloomberg or your CNBCs, they're talking a lot about rents and how rents, there's no real evidence that rents are going to be declining anytime soon, if only they're just going to continue growing. Although most are saying that they are going to have to moderate at some point because we can't keep growing at 15%, which is 5 times your average rate of growth for a year every single year. We're going to have it basically 2 years in a row. That's an incredible amount of time compression in terms of rent growth. So obviously purchasing can be challenging in a higher interest rate environment. There's negative leverage out there that you have to watch out for. Still opportunities to make mistakes, but again, the fundamentals are really strong. Transition though, Matt, not necessarily the case in the single family home market. U.S. new home sales dropped to 2-year low in June. That doesn't sound great, but from what I understand, Matt, we haven't seen any kind of decline in pricing for single family homes. We've just seen a slowdown in the actual growth. So bring everybody up to speed. What's going on in the single family home space, which is directly related to multifamily, and those higher mortgage rates are driving more and more people to apartments.
And that's what I think is interesting. And what if we saw an actual price cool down, now we'll get to the kind of Case-Shiller numbers that were released in the past week. But the sales numbers, they're down 8.1% since last month, and they're down 17.4% since last year. And this is the kind of the last month of several months of slowing apartment sales figures. So the expectation was that we'd get 660,000 new home sales last month, but the reality was closer to 590. They even revised last month's numbers down from 696 to 642. What does this mean? I think it means that people aren't buying as many new homes, which is what it says. Now, Reuters does mention that new home sales are just a fraction of total home sales, but even so, they're clearly down. What I think this really means, like you said, we got super high mortgage rates, and the article also pushes hard on the mortgage rate factor. And the article says that we're at 5.54%, which is more than 2.2 percentage points higher than it was in January. It's going to be more than 5.54% now.
Matt, how much do you think just the psychology is affecting the consumer? This is kind of going back to the recession discussion we were having a minute ago, but specifically single family homes, but the consumer at large. There's all this talk about recession. We're doing it right now. And all this fear in the economy and uncertainty, even though wages are rising, unemployment is incredibly low, but there's this kind of like acknowledgement that like, yeah, things are screwed up right now. We're like going through some pain. We don't know what it's going to look like, but we're going to be going through something and we got to be prepared. I mean, and I've seen some extreme examples of people like getting ready, everything
Yeah.
from, you've seen things online for people like, selling their house, like selling their belongings, like, getting their cash ready, which is very extreme, to people,
Yeah.
cutting back on advertising, to, not spending a certain amount, not taking maybe that trip, even though, luxury travel is continuing to come back. But people just questioning is, right now to spend money, which then makes this recession, we caused to happen ourselves.
Yeah. Well,
we will it into existence.
And I was talking to Addison from our coworker at Grand Capital, and I was saying, like, it is frustrating that everyone has got a bad attitude about the economy, but they're spending. There is activity, but it's this kind of nervous activity, this activity in preparation for, and I don't know, to a certain extent, activity is activity because that's what's driving inflation up. But like, it does seem like the perfect, this is the mindset of a population in an inflationary environment. Their spending is motivated by nervousness towards the future, by the assumption that their dollars are going to be worth less in the future, so they're buying more today. And that's the scary kind of animal spirit that I don't want to guide the economy at this point.
That is true, Matt. I mean, I'm just thinking of just some anecdotes of thinking about, like, for us, for like, let's talk about Great Capital, for example. And if we can't buy any apartments, so we can't make any acquisitions, which I think we still are going to be able to do. But like, let's say we can't because the market just doesn't support it right now. We can't hit our return metrics. Well, maybe we don't bring on a couple other people this year. Our rate of hiring slows down because we're not doing any deals. We're thinking about a family that's hey, maybe we, instead of flying somewhere, we're going to drive somewhere on vacation, or we don't get that car, or we don't we don't build that addition. I was talking to an owner of a furniture store, kind of a higher end furniture store last week, and he said that the faucet's been turned off. Last year, they couldn't keep up with demand. Everything was 6 months out to order. Now it's just people have stopped. People aren't buying that new couch or that that one lamp that they don't really need that they would like. Whereas last year, people were just spending.
Yeah.
And a lot of this is psychology, because when you look at kind of the undercurrents of what everybody's making, everyone's making more than they were last year. Now the markets, you look at your stock portfolio, it's way down, and I'm wondering if how much of an effect of just people looking at their 401ks, what kind of that wealth effect, even though it's all on paper, what is that doing to the individual? Saying, I had $1 million last year in my retirement account, I now have 800,000, 700,000, $500,000, cut in half.
Don't do it.
And it's gone.
Yeah. But see, that almost, like, from the perspective of the Fed, they must be kind of almost patting themselves on the back. Look, they raised rates, the economy cooled off. This is exactly what they want. And if it was their assumption, then that might mean that that all they've got to do maybe lower rates again, and they got that's funny.
Yeah.
All they've got to do is lower rates again, and then maybe they bring the economy back. Now that's a very rosy picture. Obviously, it's a lot more complicated than that. But there are signs that the supply chain, at least maybe driven by less demand, but some of these material prices are going down. Oil prices are going down. All of these economists are saying that perhaps inflation has peaked, and there is this monetarism, this money supply argument that says that, and this is an article that we were unable to include this week, but basically the argument, if you take a chart,
like we're including it now.
Yeah, I know. Sorry, dang it.
No, it's good.
You take a chart of it's called the M2 money supply, and if you move that forward by 13 months, it perfectly mirrors where we're at with the economy. Now that's that chart that you can see right there, and you can see how it just follows the inflation numbers right there. Now, we turned on the faucet 13 months ago, and now we're and then we started, turning it off a little, and now that's what's happening now. It's a
Now,
pretty convincing, a
mhm.
pretty convincing chart.
No, the only thing I'd like to add to that, not being an economist, but I believe the other piece to not just the money supply, but is the velocity of the money, because you can create a lot of money. Like for example, in after the great financial crisis, we did a lot of quantitative easing. The money supply increased quite a bit, not like the pandemic, but increased quite a bit. But the velocity of money was so low that it didn't cause inflation. And with the understanding that inflation is really the money supply and increase in money supply, times the velocity of that money, or something pretty close to that. And so I think the money supply is a major element, which we've saw the largest increase in the money supply, to your point, in the pandemic, and people are spending more money, fears of inflation, again, the psychological element, got to spend it now because it's going to be worth less tomorrow.
Mm-hmm.
That increases velocity considerably.
Mm-hmm.
And it's all coming back to, and I just want to go back to the point that you made a minute ago of the Federal Reserve could just turn the faucet back on by lowering rates. And that would be a shock, defibrillator shock to the economy, whether that in the short term, everyone prices would go up, everything would look great, everything would go green. The long-term effects, could be major, incredibly inflationary, because I'm just thinking for, like a group like us that's trying to buy apartments, we have incredible growth right now, still, and most likely for the next, near term. If someone's like, hey, instead of paying a 5% interest rate, you can lock in that 2.5% again. Well, my returns are going to skyrocket for what we could do right now. And so, we would lock in some, 10-year, 35-year debt at incredibly low interest rates and great assets. Right now, it's difficult because it's negative leverage to do that.
And I think of that in the reverse right now. That's the decision that a lot of businesses are making, of like, well, our financing, we've got to pay the bank now a lot more, and so we can't expand as much as we wanted to do. And that to me is like that emotional, the kind of real world effects. A lot of times I think about the money supply, it's this abstract thing, but it's really like it makes the numbers not work for more optimistic, expansionary, business plans. And it's
It's true. Now let's kind of keep going. Let's keep going on real estate. Maybe move away a little bit from the super macro, but
sorry.
Well, I was going to say I want to go to this multifamily dive piece, if that's all right, Matt. These increased borrowing costs, dent sky high apartment valuations. That's kind of what we're talking about, even though the fundamentals are really strong. But what's going to happen? Are we going to finally see cap rates really rise?
I don't know if you noticed, but I think there seems to be a slight, and I'm an English major, and so I noticed a little bit of a verb tense issue in the headline of this article. The headline asks "will," as if the article is about something that's going to happen in the future, when really, and again, this is probably nitpicky. I think the article may be in the past tense, like have increased borrowing costs dented sky high apartment valuations. I think the answer, when you put it that way, seems a little bit easier to find, and I think it's yes. I think it's already had an effect.
So do you think that they should have just deleted this article and just put yes?
Well, let's just tweak the headline, and then I'll still read the article.
Or just this bottom sub headline, the H2 just to be yes.
Yeah. That's good.
How much? That should be it's the exact question, Matt, that we were throwing out there in end of 2020 and early 2021 about inflation. It's not a question of if we're going to see a lot of inflation, if we're going to be in a high inflationary environment. It's for how much, for how long. Those are the questions we were having. And I think it's not the same but similar question of, there's going to be price adjustments. They're already happening, but how much, for how long is that going to go on for?
And I think that this is and I note this in a little bit later in my notes, is how difficult it is to get perfect information about apartment valuations and cap rates, like perfect up to the moment info. We don't have that information. It's not necessarily like a stock that we can follow. Because
it's not, Well, because there's not perfect correlation between cap rates and interest rates
Yeah.
and apartment valuations. And we've seen there's multiple periods where interest rates rose and apartment valuations were flat or increased. And,
Hmm.
so we have kind of two different forces pulling. One, we have these kind of just technical, interest rates that are rising, which, prevents, the how much you can borrow on a property and reduces the returns. But then at the same time, we've got this article from Globe Street that Blackstone has come out saying the slowdown of new construction of single family homes and multifamily homes is going to lead to a lifting of rents. And so
Yeah.
again, we see the fundamentals of the performance of occupancy and rent levels at these properties doing incredibly well and are incredibly strong. But we just have macro issues of, oh, hey, the cost to borrow to purchase these assets is slightly more, but which is going to outweigh the other.
Well, and it's interesting too, because first of all, on like the moment to moment basis, we don't have those numbers, and so we kind of rely on brokers' opinions. But if you're talking about like long term trends and maybe securing yourself, this really these conditions grant some security to owners of cash flowing apartments more than those who are looking to achieve their returns after the sale of the property. If you can kind of sit tight and wait it out, then you've got a real good thing going.
Well,
But
and also, where else are you going to go? What else are you going to do? Well,
Yeah.
Okay, you've got some money on the sidelines you have to deploy. You can leave it in cash, ready for an opportunity, which I don't think is a bad idea. But you're losing, what, 8% to inflation.
Mhm.
You can put it in, the market, which is incredibly volatile. It's going to go up and down. Maybe not a bad idea because we're relatively low. You're not buying at the height, but there's a lot of risk. There's no tax advantages, or there's an asset class that has similar growth prospects as the stock market, but with tax advantages and actually doing well right now. And so again, it's just this point of interest rates and cap rates and apartment prices not being that they're correlated, but they're not so tightly correlated, because you also have this demand from investors who are saying, yeah, I'll take a slightly lower return because I want to be in the space. I want to be in
Yeah.
multifamily. And again, talking about earlier of hearing on the financial media on CNBC and Bloomberg of people talking about apartments, which again you never used to see. Now there's a big difference though between the performance of REITs and actual private real estate, because REITs are in the public market. They can be traded. It's paper real estate. And if you look back in a higher inflationary environments, sometimes REITs don't, especially in stagflation, REITs don't do that well, but often the private real estate underneath it does.
Mhm.
A lot of that's just linked to the valuations and how REITs are traded versus the illiquid nature of private real estate.
Yeah.
So you've got all this demand that can act as a limiter on the expansion of cap rates, a little bit of a ceiling. Now I'd say it's a little bit of a glass ceiling. There's nothing really preventing people from breaking through that.
Yeah.
Other than the psychology and what people want to do, where they think the market is going. And if you are concerned about the future, if you're concerned about inflation, you're buying a real asset that is producing income, that is limited in supply. There's not a huge pipeline for supply, especially where we're investing. It seems like a pretty good place to be.
Oh, in that multifamily dive, they put some hard numbers to what you just said. According to Real Capital Analytics, the number of unique buyers in the market was 13% larger in the second quarter of 2022 compared to the same period in 2021. So there are more people entering this market, and it's because of the reasons why you just said. There's not a whole lot of alternatives to these assets.
And it's also there's some healthy aspects to this that's going on in the market right now. I wouldn't say the multifamily market prior was over levered. I think probably average leverage is around 75% loan to value, relatively moderate. It's not 100% leverage. It's not 80s, 90s. But now, the leverage is kind of in that 50 to 70% range, which a lot of leverage landing kind of like 60% LTV. So using less leverage, it's going to reduce your return, but it also reduces risk. So the market in general is taking a much more risk off approach. And as a buyer and investor, you're going to have to kind of pay up in terms of how much money you have to bring to the table to close on these assets. which is removing some buyers in the first place if they can't come up with the equity. But it gives an opportunity to refinance in a couple of years. Maybe rates are a little bit lower. Hopefully valuations are much higher, and allow you to pull out a lot of that equity tax-free through a refinance. So that's going to be pretty exciting when you are purchasing at a 50%, 65% LTV. Even if the value stays flat, if interest rates lower within the next 5 years or so, you can pull a lot of that cash out tax-free. It would be very kind of converse to kind of historical trends that values wouldn't be up slightly in 5 years. And so you might be able to fully de-risk the asset and pull all of your capital out, which is exciting.
Yeah, and that's another thing that I was noting too, is like, if you have that capacity to kind of sit tight, but on the opposite end, maybe you were making more of a kind of speculative play on just the end and just the sale of the property. If your sales coming up, if your loans come, the terms of your loan is ending, then you're entering in an environment that's not great. It's not as appealing as the one that you.
It's not, especially if you want to refinance. It's like, it doesn't look like a great option right now. Yeah. You may just have to sell it, and hopefully there are still buyers willing to pay a premium. I think that number is getting less and less, but they're still out there. We're in the middle of a transaction right now, and we're basically getting the pricing that we want. So, that's it is still happening. Matt, I wanted to shift just real quick. First of all, appreciate everyone watching this video, listening to the podcast. We'd really appreciate you subscribing to the channel, giving us a like, putting a comment below. Means a lot. It helps the channel, gets this information out to more people. But something else that I would like to invite everyone to go and check out is the brand new Gray Capital website. We've been working on this for, I don't know what, Matt, like a year or so. It seems like a long time. You can check it out, graycapitalllc.com. You can learn all about what we do at Gray Capital. You can take a look at the different properties that are in our portfolio. You can learn all about the team, the company, our track record. You learn about our investment vehicle, open to accredited investors, which is the Gray Fund. Again, get full bios on our awesome team. You can check out case studies. I think the case study piece, Matt, is really cool. You can kind of take a look at some of the properties that we've done, either currently or in the past, full cycle projects, learn a little bit more, kind of what the business plan was, what the results of that project were. Of course, you can learn all about what it's like to invest with Gray Capital, the team, whether it's through the fund or directly into a project itself. All those have a little bit of a higher minimum. You can learn all about the Gray Fund, watch videos, learn why we think it's a good time to invest in apartments right now. And schedule a meeting with a member of the Gray Capital team to learn more about what we do here. So anyway, check out the new website, graycapitalllc.com. You will not regret it. It's awesome. All right, Matt, just to kind of close things out, let's talk about the suburbs. Ready to go?
Oh yeah, totally.
Okay. So you and I live in the city technically, but it used to be the suburbs back in the day.
We're all the suburbs of somewhere. That's true.
Yeah, we're all the suburbs of somewhere. Exactly. Even in downtown, it's the suburbs are right outside of downtown, and just they were in the 19th century. But so there's a couple articles, one from Vox and one that Marcus and Millichap put out a video about. Vox's point of view, what if the suburbs are really a first draft? When we think of suburbs, or you and I still probably think of suburbs, if we think of at least here in the Midwest, we think of cornfields being, turned over, and large subdivisions of homes that all these vinyl villages homes that all kind of look the same, kind of going in, and quiet life, not a lot around. You kind of have to drive into town. You're maybe 15 minutes away from something. The suburbs of our childhood, Matt, they've changed a lot. There's often now more stuff going on up in the suburbs than there is going on down in the city.
And it's funny, we've kind of talked about this anecdotally and a little bit in the Gray Report about how the suburbs, at least in Indianapolis, and I'm sure throughout the country, are becoming these little downtowns almost. I was talking to a friend about the suburbs around Indianapolis, and And look, I don't want to live in a society where people living close to downtown don't have some kind of rivalry with people who live farther from downtown. Um, and that being said, like we're all the suburbs of somewhere. But I think that the suburbs are definitely changing, and the quote here is it says this desire to be near things is as likely to lure millennials leaving the city to seek less expensive housing as it is immigrants coming from countries with more traditional urbanism and remote workers looking for amenities they used to find near their urban offices. What makes suburbs desirable for many people today is not what Americans traditionally associate with the suburbs. It's vibrant dining scenes and nightclubs, taller buildings, and walkable developments. So one of the undercurrents of this article, and I said this before, is the idea that millennials want the same things they want downtown to be there when they move to the suburbs. More accurately, I think, and Fox hints at this, but not as directly. There is a big enough population in the suburbs that can support some of the downtown amenities. Now, sometimes
you get the grocery stores and the restaurants and the big box retailers.
Yeah, and now sometimes there are heavy-handed government intervention, and they kind of create a little district for everyone to gather around in. But I don't think that you're getting to that level unless you plan density, a little more density than your typical suburban neighborhood. And yeah,
and hasn't that to me? That seems to be the kind of the key to success for a lot of these suburbs that are really, really thriving, is that they have built out an urban core. Oftentimes not big, but there is an urban core. And others that really haven't are kind of still sprawled out and they're growing, but they're not growing at the same extent, and they're kind of playing catch up to that. Matt, do you think there's a little bit of nostalgia in this? And I think of demographics and millennials being kind of peak, more millennials now than anything. A lot of millennials grew up in suburbs too. And then we left the suburbs and we're like, this is lame milk toast. No, I don't want to deal with HOAs, move downtown. And then all of a sudden everyone, got jobs, married, having kids. And there's all this like nostalgia that's going around, whether it's the 90s nostalgia, and you look at the bands that are going on tour that are selling a lot of tickets. It's like the bands that were big in the, mid 2000s. And so, you think there's a little bit of nostalgia for the suburbs, even because you can go back and they're actually like nicer. They're like way better than you remember, and you get some space. And your friends live there now.
Well, I think that there's a little bit of reverse nostalgia for the early 20s. For the millennials in their 20s, they were in downtown and they want to bring that back to the suburbs.
Good point.
I do think that now this is very, very oversimplifying, but if a person grows up and gets a kid, they're probably going to want a bigger yard than they have downtown. And that's
not even mentioning schools also.
It's schools and like just raising a family and starting a family, you're going to want more space. Now, I think that's the weird part about what's happening now in the suburbs is I don't think it's necessarily all people that want a yard, a dog, and 2 kids and a wife and a husband. Maybe you get all of them. But I don't think that you get all of them if you're living in a dense suburb. So maybe there is a larger proportion of renters that are able to create these walkable suburbs. Because this is what I was thinking of, like, if you want something that's truly walkable, it seems to run counter to the idea of large yards, because I'd much rather walk past a single apartment building than I would walking past 50 yards.
Well, that's why you're seeing all the zero lot line developments. I feel like more developments I see have much smaller yards. They are much more dense, and also it's often a little bit I don't know, a little rattling, because it's so different from the subdivisions that were built 15, 20 years ago with big yards and like kind of the McMansion. Now they look, some look nice, some look a little cheaper, some look really, really nice, but they have zero lot lines. A lot of this is targeting more retiring baby boomers, but just people who are like, mowing the yard is like a thing I don't want to have to do. I don't want it to take 1 to 2 hours every weekend. I want to do it in like 20 minutes. Or like if I hire someone to do it, it's going to be half the price. So you're seeing that density, and I think people want a yard. Not everybody wants a huge yard. And we're seeing that demand in apartments, and one of the value add tactics that we're utilizing right now when we look at any acquisition is if can we put in private yards into first floor units and garden style apartments where we'll fence in a portion just right off their patio or maybe near their front entrance and fence it in and put in artificial turf. So if they've got a dog, they have kids, they have like a little place they can go. They can let their dog out. Their kids can just play outside in their little space. You know, have like a little, garden with some planters or something. But it's your space to be outside.
Yeah, it is interesting, and I'm probably overstating it in saying that there is a lot of room for experimentation in the suburbs. But you do get, suburbs are starting to be this place where, yeah, you want some space, you go a couple blocks to the west, and you can have your big yard. You want the kind of downtown feel, you can have that. If you want a kind of middle ground where you're still an apartment, you still have a small yard, then there is space for that. And I just think it's very interesting, and it's a lot less like the suburbs that we grew up with. That being said, as much as like people from Marion County or from Indianapolis proper will perhaps roll their eyes at Carmel, Fishers, Noblesville, Zionsville, but all the suburbs. But man, you drive past there, and even my son was like, oh, "This is a lot of space. This is really nice."
Yeah, this is nice.
Yes, it is.
Nice. Yeah, and I can see the appeal. I'm still in Indy, but I haven't been able to carve out a little bit of space here, kind of in the city. But it's there's definitely the appeal. It's all nice. It's new. It seems clean. It does make sense. Something I'm going to relate this more to the multifamily market, Matt. But I think it goes to show that, the suburban assets are commanding a premium. We were going after two suburban apartments recently, and they're going to go for low cap rates, and they're going to go for mid fours, low fours. Yeah. So they're still commanding a premium. That's where we're seeing a lot of growth, and that's where I recommend anyone, if you're looking at apartment markets for potential acquisitions or just studying markets, don't just look at the full CBD. Break down the sub markets, whether you're using a CoStar or some other demographic market research tool. Look at all those sub markets and look at where that growth is, because you'll see a lot of times in the CBDs or just the city, you're seeing decent growth, moderate growth, but in the suburbs, it's just like crushing it. You're seeing incredible numbers. And so that's where some of those gems are.
And some suburbs more than others. Yeah.
Some suburbs way more than others. But that's where you can go into a market that if you look at it, if you analyze it as a whole market, you might say, I'm not too excited to go here. It's okay. But then you're like, if you just look a little bit deeper, get a little more granular, you can find these little pockets that are they're just like, they can be little gold mines. Yeah. So I would take a look and check it out. Marcus Millichap has another good video on CRE momentum shifting to the suburbs. We're not going to watch that today, but you can go check that out on the Gray Report website, grayreport.com. And if you're signed up for the Gray Report newsletter, which again, you can do at graycapitalllc.com/newsletter, you're going to stay up to date, check out the video, but make sure you've subscribed to the Gray Report YouTube channel. You're getting the podcast as well. I'd love to hear some opinions on this whole suburb discussion and recession. Are we in a recession or not? What's your definition of a recession? And are multifamily prices, are they going to drop like single family? Well, single family home prices haven't dropped, but are they going to really cool like single family home prices? Are we going to see some continued momentum? What's going to happen with cap rates is what I'm asking. Prices going up, prices going down. Nobody knows. If they tell you that they know, they are full of it, including any economists, because they've gotten it wrong so many times.
They'll comment on it. And if you know that there's a recession, please put it
if you've got to figure it out, let us know. We'll have you on the show.
That's right.
We will have you on the show. All right, guys, remember, go to graycapitalllc.com. Let us know what you think about our new website. Learn about the Gray Fund, all the fun stuff going on over at Gray Capital. Opportunities are only open to accredited investors. We're not giving any kind of investment advice here. We're just having some fun, entertainment, talking about real estate. Matt, any weekend plans? Doing anything fun?
Not as much fun as you're going to be having.
Oh, it's true. Well, I don't know. About
where are you headed? Where are you
going to Vegas? Going to Vegas. Haven't been to Vegas since the pandemic, so got to do some research in Vegas.
Look at the market there.
Yep, demographic research.
That's great.
Really. All right, guys. Thank you so much for watching us again. Subscribe and share. this video. It helps the Gray Report get into hands and eyeballs of so many more investors and industry insiders who need this type of content. Appreciate you watching it. Catch the next Gray Report video next week.